On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. In recent weeks and months, the New Zealand dollar has weakened against most trading partners. It's doing exactly what you'd expect it to against a challenging economic backdrop, and whether this is good or bad depends on your perspective. Right now, the Kiwi dollar is down 6% against the US dollar since the beginning of July, while it's at a 3-year low against the Australian dollar. We're under 50 against the euro, which is something we haven't seen since late 2009, more than 15 years ago. Currency markets are where the growth outlook, inflation expectations, and interest rate differentials all intersect. And right now, New Zealand is in a tough spot. Our economy has been weak and the Reserve Bank has needed to reduce interest rates to help it. That makes us a less attractive proposition for global capital, so that money chooses to move elsewhere. It's an important shock absorber though, and a very effective one. A weaker New Zealand dollar is a tailwind for the export sector. It makes us more competitive internationally and it pushes up the value we get for our goods sold overseas. China is our biggest export market, while in recent years, Australia and the US have been jostling for number 2 and number 3. Like most commodities, dairy products are priced in US dollars, so when the New Zealand dollar is softer against the greenback, that feeds directly into the calculations for what farmers might receive here at the farm gate. The tourism sector is another big beneficiary of a weaker currency because we've become a more affordable holiday destination. Australia is our biggest market for international arrivals, and we look much more enticing at 88 cents than we did at 94 back in April. With the euro buying some 13% more than a year ago on our shores, it'd be nice to see a few more German tourists too. This added support for goods exporters as well as tourism should help the economy recover, boosting export incomes and lifting demand. That improving backdrop should lessen the need for more rate cuts, and at some point it might justify the OCR heading back up again. That's not a bad thing if it comes on the back of an improving economy, rather than problematic inflation. Speaking of inflation, it can be the other side of the weaker currency coin. A lower New Zealand dollar leads to higher prices for imported goods, including fuel, raw materials, and everything else we source from offshore. Currency movements have a big impact on exporters, consumers, and prices, but they also matter for investors. For your investment portfolio or your KiwiSaver account, currency moves can go against you or work in your favour. In recent months, it's been the latter. Despite the recent volatility, global markets have still performed very well this year, and the decline in the New Zealand dollar has supercharged those returns further. However, when you look out 12 months or more, this tailwind could become a headwind. At US 57 cents, the Kiwi dollar is almost 14% below its 25-year average of US 66 cents. It's also weaker against the Australian dollar, British pound, and the euro than it has been for much of the past decade. If you believe in mean reversion, you'd say we should trend higher against all these currencies over the next year or two. This is something to be mindful of, but currency moves shouldn't drive our decisions. It's more important for investors to focus on great businesses with good prospects, wherever they happen to be. The same goes for business owners, who can only do their best to manage currency risks. There's no perfect level for the New Zealand dollar. Ideally, we want it low enough to keep our exporters competitive, but strong enough to maintain our purchasing power in the global marketplace. A weak currency really is a double-edged sword, and the sweet spot is arguably a little higher than where we are right now. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.